Hey, what's up guys? Welcome back to the channel. My name's Frank Mularcik and this is going to be episode 6 of my portfolio analysis series where I go through my individual holdings in my portfolio, talk to you guys about them, and just go over a brief stock analysis of them, sort of break down their business and what they're up to and how they're performing financially, and most importantly with my dividend portfolio, how they are doing paying those dividends and what kind of dividends they are paying. So if you guys do like these videos, make sure to like the video and subscribe to show your support to the channel and so you don't miss out on any future videos. And with that out of the way, we can get right into it. So the 6th position in my portfolio that we're going to be going over by market value is the Travelers Company, ticker symbol TRV. And as we can see on their investor relations, Travelers is a leading provider of property casualty insurance for auto, home, and business. And the company's diverse business line offers its global customers a wide range of coverage sold primarily through independent agents and brokers. So as you can see there, they're just basic insurance company. Honestly, pretty boring if you ask me what the business is, but as Peter Lynch has said multiple times, oftentimes companies that are boring are often great investments because not many investors are looking at them, and so they might be undervalued in that case. But we're going to take a look at that, and as you can see here, their market cap is just under 35 billion, which is fairly decently sized, so I like to see that. So first we're just going to take a look at their third quarter earnings for 2020, as their fourth quarter isn't out yet. It should be out sometime at the beginning of January, but basically they said net income per diluted share of $3.23, which is up substantially from prior year's quarter. So basically if we look at their revenues, they're actually up a little bit from last year, third quarter, Q3 that is, about 3%. But the interesting thing is their net income is way up, which is up over 100% in that 800 million range for the third quarter, which is pretty nice to see. The problem, however, is if we look over here, and also that per share net income is up over 100% as well. And the other thing that's nice about that is you can see that you would think that the net income per share would be the same increased percentage as the net income. However, it's even more for when you're looking at the earnings per share, and that is because they're lowering the amount of shares that they have. They're doing some share buybacks, which we're going to look at as well in the future. But the concerning thing is, or the thing that's not so good to see, is that most of these numbers are down. Most of the income numbers are in the negative for the 9 months ended September 30th. So the first 3 quarters, basically, from 2019 to 2020. So basically they had almost $1.4 billion of income those 3 quarters this year, and they had $1.75 billion last year. So that's around negative 21%. And then a little bit less for the EPS there. But overall, obviously it's not awesome to see that drop, but obviously I think we know why that is, because of the pandemic. So at the same time, that is expected. So just looking at this annual report from 2019, basically they had $2.6 billion in net income, and they say that they returned $2.4 billion to shareholders, which I don't exactly understand how that works, because we'll talk about that in a second, but sorry, I'm getting ahead of myself. So their total revenues were right around 31.5 billion, which, as you can see, these are the numbers I really love to see. They're just increasing consistently, little bit by little every year, and that's obviously good to see. And their income was about 2.6 billion. And again, those continuing increases, looks like in 2015 and 2016 they were over 3 billion, so it's not good to see that drop there in 2017, but they've recovered nicely from it and are increasing ever since as well. As you can see, their total assets are increasing as well, which I like to see, and that shareholders' equity is also increasing, which is obviously good for us as shareholders. So if we look at the dividends, those have been definitely increasing nicely, and this is where I wanted to talk about the shares. So I did some quick math with the amount that they're paying out in dividends and the number of shares they had in 2019, and basically it was somewhere around 900 million that they paid out in dividends. And maybe I am mistaken, but I don't think they did almost 1.5 billion in share buybacks, so I'm not exactly sure where they're getting this number. Maybe they're just saying it to sound good because they can say that they did dividends and share buybacks, and maybe with the stock price appreciation that is counting in towards that as well, but I'm not exactly sure how they got there. I was trying to look through the share buybacks number, and I couldn't really find anything that was definitive as to how much share repurchases they did in 2019. So that's why I was unsure where they got that 2.4 billion, but that's still pretty good to see. So I also wanted to look at the balance sheet real quick because that's something I always like to look at. So basically their total investments or current assets, you could say, is around $78 billion, which is really good. And they really don't have a current liabilities listed, but I think this 51.8 billion is sort of what their current liabilities are, because those are basically claims that they have to pay out. So that's basically their current liabilities. So obviously that's good to see they have more assets than liabilities in this case, and then obviously their total assets is definitely bigger than the total liabilities. And like I said before, this shareholder equity over here is definitely increased year over year, which is really great for us as shareholders to see, because that means we have basically a bigger pie. And as I'm going to show you in a second, we actually have a larger piece of the pie as well, because I like Yahoo Finance here because they do a really good job. You can look at the number of shares here, and if you look over from 2016, they had almost 288 million shares, or they had over that, and now they're only at 260 million. So that's pretty good, steady decreases year over year, which is definitely good for us as shareholders to see. I did a video a little bit ago actually about the difference between dividends and share buybacks, because as a dividend investor mostly at this point, that's an interesting conversation to have of which is better. So I will leave a link to that up here if you guys want to check it out. But I really like to see, like I said, that they are decreasing those shares. Okay, so also just looking at Seeking Alpha here at the dividends, they have a yield of about 2.5%, which is pretty conservative, but definitely a solid yield as well. And their payout ratio is super nice at just under 40%. So they could honestly continue this super awesome 8.5% year-over-year dividend growth for a while into the future, hopefully. But unfortunately, it's only been 15 years they've been increasing that dividend. However, I think they can continue that for a long while into the future, especially with this nice payout ratio. We will look at the dividend growth, and it has been slowing a little bit recently. So hopefully they can do a better job in the coming years of working on that. But we will see what will happen in the future. It looks like they had to cut the dividend in 2003 to 2004 for some reason. I'm not exactly sure why that happened, but things do happen. But I think they're getting back on their feet and doing a lot better recently, so that's good to see. I definitely need some companies with a little bit higher dividend CAGRs, so I like to see this one in my portfolio. So also then, just looking at this stock chart here, for the 1 year, it really hasn't gone anywhere, but 5 years, they've definitely had some improvements, but obviously with the recent crash, it has not helped them that much. But looking at their PE is around 16, just under 16. So that is an interesting thing to look at, because I looked up some financial, trying to get a good grasp of what the PE is for financial companies, and actually for the whole market, the S&P 500 is like a 37 PE. So in comparison to that, you could say Travelers is hugely undervalued at the moment. But for the financial sector, this says a PE is 4.51 for the fourth quarter. But that doesn't make sense to me. They listed out all of the basic industries within financials as of Q3, and you can see most of them are a lot higher than 5.41. So I'm not exactly sure where they got that, but the ones I wanted to look at were insurance, property and casualty insurance. That's mostly what Travelers does, is property and casualty. So that is 17.66, and Travelers was 15.86 at the moment. So you could say Travelers could be a little bit undervalued based on the PE, but obviously if you want to get a real sense of the true valuation, you might have to do a lot, or a little bit more deeper digging, maybe do some DCF calculations or something like that, but I'm not going to do that at this point. So just looking at my portfolio here with the companies that I've talked about so far, you can actually see Travelers is below Apple now. So the last video I did in this series was for Apple, so if you did miss that, make sure to check that out. But because of some recent news regarding a electric car that they might be producing in the next few years that could be really interesting and possibly a competitor to Tesla, their stock price has been doing pretty well the last few days, so I think that's why they've surpassed my Travelers position actually. but that is okay. I have about 0.271 shares of Travelers for a total value of about $37.53 at the moment, and they make up about 3.48% of my portfolio at this point. So overall, I really do like Travelers as a company. I like their business model. Obviously, like I said at the beginning, insurance is a pretty boring business in my opinion, but as I stated earlier, Peter Lynch, I was reading his book, One Up on Wall Street, and he was talking about how if a company has a boring business or a boring name, that often could be good for them, and not necessarily good for them, but that could provide you as an investor a good opportunity to find something that might be at a good deal, because I think he was sort of talking about hype in the market, and as we can see recently, hype in the market has really done some crazy things with some interesting companies that I will not name. I don't want to throw any under the bus specifically, but that's what he was sort of getting at, I think, and I think that's even more apparent today. So a boring company like this, I think it's always good to have something like that in your portfolio, just to give you some grounds and basis to stand on. You know that company is always going to be solid, and I think Travelers is a pretty solid company overall. And the quote of the video is, "Do something today that your future self will thank you for." And I included this one just because I think it's a great quote. I think you should do something today that your future self will thank you for. And since I was talking about Travelers, that's sort of what insurance is about. You know, it's ensuring that your future will be okay, and if you have some problems in your future, you will be covered with some, if you have some big expenses, you know. So that's really what investing is all about, you know, is making sure that you will be okay in the future, and you'll be able to do whatever you want in the future and have the freedom to do that. So I hope you guys did enjoy this stock analysis of Travelers. If you do have any questions, make sure to leave them in the comments below, and I'll see you in the next video.